Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So are you looking to buy a house in Dallas, Texas, and you're still a little concerned about what's going to happen with the future of the housing market, but more importantly, what's going to happen with the future of interest rates? Stick around. In this video, I'm going to do my best to predict the future. So listen, if you're a potential home buyer out there and you're looking to get a property, there's been a lot of talk around what does next year look like? How strong is the economy going to be? How strong is the housing market going to be? More importantly, what are these interest rates going to do? So let me start with the interest rate topic first. Interest rates are slowly starting to come down. They're tied to inflation. People are still thinking they're a little too high. They don't love the payments around it. I would actually argue the latter, that sometimes higher interest rates are a buyer's best friend temporarily because it cools the market off just a tad and it gives them an opportunity to purchase a house and maybe even get a good deal on a house where they can't in a low interest rate environment. See COVID 2 years ago when rates were in the 3s and the 4s, barely in the 2s, you could get a great interest rate and a cheap payment if you could get your hands on a house. And even at that point in time, if you get your hands on a house, sometimes you're overpaying by 20, 30, or 40K. So I don't mind the fact that interest rates are a little bit higher. I think it's leveled the playing field. But the biggest component is now that we all believe the hardest part is behind us, people are trying to time the market. They're trying to wait and buy. I want to remind everybody with the number one key to real estate is always buying and waiting. People that become successful via homeownership and create wealth don't always try to wait and buy, they buy and hold. It's a smarter strategy because historically, real estate goes up every single year. Yes, there will be some dips, there will be some corrections, just like the stock market, but if you look back at a 5 or 10 year trend, you will see that you're most likely gonna make money. Especially here in Dallas, Texas, the growth of the city has just gone bananas. I don't think it's going backwards. I don't think it's going to stop. And so what we're seeing now is even though interest rates aren't where everyone wants them, there's still a lot of demand for houses. There's still a lot of multiple offers. There's still a lot of people that can't even get in the housing game. And that just comes down to two things, really. It comes down to the population growth. There are so many more people pouring into the cities than inventory available. You've just got 3 and 4 people for every single house, and people are just having an increase in demand, and they're not able to get a property. The second piece around it is, a lot of the homeowners in Dallas might want to consider selling, but they've got one of those great 3%, 4% mortgages, and they just don't want to let that thing go. And so until interest rates come back down, let's call it, sub 6%, somewhere in the low to mid 5s, it may not entertain the idea for those sellers to let go of their properties. And so the combination of a ton of people growing through the city and the combination of not a lot of people that are current homeowners letting their properties go because of the equity they're building and that low interest rate mortgage that they've currently got on their property just doesn't give current buyers as much inventory as you would think. So here's the strategy and the thought behind it. I would consider for buyers out there looking at buying a property now. Let's say on a scale of 1 to 10, everyone wants an 8. Well, the problem with the 8 that's turnkey and ready to go is everybody wants the same property, so it's going to be more expensive, harder to get, there's going to be more offers. I would encourage you to say on a scale of 1 to 10, look at that 6. That 6 is good enough. You don't love it, but you like it. And what I would say is get that house that's a 6, get it at the interest rate of whatever it is today, hypothetically, 6.75%. But you may be able to get some concessions. You may be able to get some deals from the seller, whether that be money towards closing cost, maybe a little bit off the price of the house. I, for one, really don't love taking money off the price of the house. I think it declines the area and the neighborhood and the comps, and honestly, it doesn't do anything for you, the buyer. I prefer when a concession can be given to take that money and use it towards closing costs, or more importantly right now, to do temporary interest rate buy downs. A lot of people are doing 1-year buy downs, 2-year buy downs, 3-year buy downs. That basically means that your interest rate is going to start really low for a short period of time, a year or 2 or 3, and it's very cheap to do, and it saves you a lot more money and the payment that it would take it off the price of the house, and you can refinance when those rates drop. So the trend about rates dropping are projected all the way through 2025. I saw an article the other day that they think rates could get as low as 4% again by the end of 2025. Now, I am not that confident in 4%, but I do think by election time next year, you will see rates probably sub 5. And I think that's super competitive and people need to know that. But the problem is that if everyone's waiting until interest rates drop and we're already tight in inventory, just imagine what's going to happen in 2024 and 2025 as rates come down. More buyers are going to come off the sideline. That's going to push demand up. That's going to make it harder on existing inventory, and that's also going to push the price of the house up. And that's the one thing that I don't think people pay attention to, that they need to pay attention to, which is if you've got a $400,000 house right now and your interest rate is 6.99, you might not love the payment. A year from now, let's say rates drop to 5.75. Yeah, you might have saved, $250 in the payment. The challenge is that if that interest rate is at 6.99, it drops to 5.99, but that property is 400,000, and this time the following year it's 450. The problem is that the consumer is now going to pay $50,000 more for that property, and it's going to cost them more money, where they could have bought it earlier, refinanced the note, but at least they understand their position with the house, and as demand continues to go up, it's going to continue to push their equity up, and the return on investment becomes much, much quicker and immediate for that potential home buyer. So there are always so many sides of the coin when it comes to this argument of, should I wait, should I buy, where are rates going, should I buy it down? These things are super important to consider right now, because we're still in a time to where the market is soft enough to where you can make adjustments, but it's starting to trend up to where people understand that, as rates fall with inflation towards Christmas sometime in 2024, it's going to push the demand up. I personally remember 2 times this year already where interest rate drops by about 0.5% for 2 separate spots in the last 12 months, and we saw a surge. We saw a surge of offers quickly, and so it leads me to believe that people are eager to buy a house. They want to buy a house. They don't love the situation right now, but the terms are okay. The ability to get a house is okay, and I think a lot of people, when you look at the numbers of buying now versus waiting in a year, yes, you may get a cheaper rate, but it's going to be harder to get a house. You're going to pay more for a house. People are considering putting in offers now, especially with the thin inventory. Last but not least, the most important thing is everybody has to understand that, we are in a place to where things are not going to get cheaper quicker. If our interest rates continue to decline over the next 24 months by 1.5%, that is going to push the volume up, and that's going to push the demand up for houses. The other component is, look, if you're buying a house today, on average, homes appreciate at 5% a year. That's a 20 grand appreciation naturally each year. If you keep the house for the next 2 to 3 years, you would make probably 60, 70 grand off that. That's in a natural appreciating environment. But if you're buying a property right now and we've got a rate drop and a refi boom over the next 24 months, that's going to push your property up probably not 5% a year, probably 10% a year. So all of these things you need to take into consideration. Interest rate is important, payment is important, but it's also the full scope of how to not buy a house, what we're going through right now, and obviously the predictions for the market for the future. So listen, hopefully you found this video useful. I know there's a lot of moving pieces when it comes to buying a house, especially in this market, but if you did, do me a favor, like, comment, subscribe, or even share it with somebody that you know that could benefit from this conversation. If you want to set up a pre-approval call with me, do me a favor. Call me, email me, text me. Either way, I'm always here for you. Until next time, stay tuned.